This is TreppWire Weekly Review for week ending October 1st. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, Congress averted a government shutdown with just hours to spare as investors digested mixed economic data. Initial jobless claims were higher for the third straight week. Durable goods orders rose sharply in August. Pending home sales rose more than expected in the same month, and home price growth jumped to new heights in July. Manus, stock markets ended the day down, and analysts point to concerns over inflation and supply chain issues. Or is it simply a seasonal blip?
Well, certainly September was a dismal month for equities. I think it was our worst month in about almost a year. The NASDAQ is down about 6% off its high at this point. But I have to say, for the better part of 3.5 weeks this month, I kind of chalked it up to the stuff going on in Washington, the debt ceiling debate causing jitters, partly people concerned that the market was overvalued. I didn't put a lot of credence because, with every downturn, we had seen a real bounce back in stocks after every inflation scare or a supply chain concern. But I would say over the last couple of days, I think my opinion has changed. This seems to be going beyond just your DC debt ceiling brinksmanship worries at this point. And I think evidence of that came today with, retail really selling off hard after Best Buy's announcement about supply chain issues and rising costs, right? The headline today, Bed Bath & Beyond down 20% over these issues. And that really had a contagion. Gap down 8%, Ross down 5%, Dollar Tree down 5%, Walgreens down 3.5%. Even Home Depot today, one of the darlings of the pandemic era, down 2.5%. So I was probably not giving enough credence in the past to the fact that supply chain issues and inflation are really starting to unnerve investors at this point.
Yeah, I'd also just jump in and say, some of these brinksmanship deals in DC cause a little bit of turmoil in the Treasury market, right? Because, they literally just passed a bill to fund the government for another month and change or 2 months, which I just think is hilariously dumb that they do this, that they do this the way they do this. But anyway, when the 10-year Treasury jumps up above 1.5%, there's all of a sudden, I think, kind of psychologically and algorithmically across all of the extremely highly valued growth tech type names, that's when you see those really sell off. I think it was Tuesday, I was in the office looking at the TV and seeing, Zillow and Zoom and Amazon and all these other, high PE multiple firms down 5, 6, 7, 8%. As much as discounted cash flow modeling doesn't really matter anymore, when you're discounting future earnings at 0% and then you increase that to 0.5% or 1.5%, that is a big difference. And the flow of funds, I think, is the biggest worry, right? Right now, funds are flowing into anything and everything that has any sort of expected return, which is not treasuries and not savings accounts. But if that changes, then you could see billions or trillions of dollars, moving back into more normal kind of safer assets, which would be bad for all of these kind of high growth names. So the other part of this that I thought was actually, it's kind of the non sequitur, but kind of interesting or funny if you're kind of Schadenfreude type like I am, which is those 2 Fed governors stepping down. I don't really know what to say about it other than, at what point does there have to be some rules around there, right? They were trading stocks. I don't really know the whole story.
Going back to the numbers about a week ago, we were talking about a 1.3% Treasury. We got as high as about 155, 156, 25 basis points. And to my earlier point, for most of the week, I was chalking that up to, debt ceiling shenanigans or lack thereof in Washington, right? That was pushing rates higher. But now I'm not so sure. Right now that we've seen Bed Bath & Beyond and others have these issues with costs and so forth, that I think it may be more of a situation where people are starting to think inflation is not transitory, as has been the talking point for quite some time.
I'll give our friend Yanni another shout out from a couple months, maybe 2 months ago, when he came out and said when we were talking about what the catalyst would be, and he was mentioning shipping container costs and things like that. And, it might be a case of all of these issues were happening over the last several months, but big giant chains buy things well in advance, and they probably were able to kind of get through it in Q2, but in Q3, it really started to hit them, right? And
yeah, maybe this is a call out to our listenership. Tell us where you're seeing supply shortages, if you are in your markets, whether it's food products or industrials or anything else. I know we've heard stories of car lots being, 1/3 full, largely because of shortages in getting chips, and because the chips are not available, you can't finish the car and the car can't be delivered to the dealership. But we'd be curious from our listenership if you're seeing other things. We certainly know there's a shortage in employees at this point.
So inflation is now officially not transitory because of the item that Martha was mentioning before, Dollar Tree. Dollar Tree is no longer, or is it Family Dollar?
No, it's Dollar Tree, but I didn't mention it.
Oh, you didn't mention it? Well, you did before we press record. Uh-oh. Yes. Well, there's a little inside baseball for all you listeners out there. We do talk before we press record, but it's no longer Dollar Tree. It's Dollar Plus Tree.
Dollar Tree Plus.
Dollar or more tree. So, I mean, come on. Like, your whole name is keeping it under $1, and you can't even keep it under $1. Inflation is no longer transitory, if it ever was.
We're closing in on the final CMBS delinquency numbers for the month. Manus, where do we stand at this point?
Well, our loyal listener, BS, he is...
just hold on a second there. It sounds a little bit like you're calling our loyal listener BS. And I don't mean that as an initial. It means,
No. Those are his initials.
So let's be clear.
So I'm not calling him out as
yeah.
As a false prophet or anything like that. He's a real person with his finger on the pulse. I would say, the vast majority of his predictions over the last year, whether it's with regard to delinquencies, financing available, recovery, things like that, all of that has been really spot on. And he's been saying for months that, the recovery in CRE will continue. And sure enough, it looks like he's going to be right again this month. Our early indications at this point are that the overall delinquency rate will drop about another 40 basis points down into the low fives. This time next month, we may be talking about a delinquency rate below 5%, which would just be extraordinary considering what a body punch this economy took and commercial real estate took in 2020 and early 21. Special servicing rates, similar, down about 40 basis points. On the retail and lodging sectors, both special servicing numbers and delinquency numbers, each property segment will see about between 50 and 70 basis point improvement in their numbers. So, and retail may come down to below 10% if these preliminary numbers stand.
So we also had, speaking of delinquencies, we had another report out. It's actually a little bit lagged because this is bank data, so it takes a little bit longer to collect and get everybody kind of contributing and put it all together. But we had a Q2 2021 taller report that our colleague Matt Anderson put together. That's the Trepp Anonymized Loan Level Repository. I love that name, by the way, taller. Just saying, taller is always better. So, nothing too shocking here. I think the delinquency rates on these bank loans had peaked back in Q4 2020, and they've been coming down, I'd say, reasonably since then. It was around 1.3% total delinquencies in Q4 2020. Now it's down to just over 1%. But a little interesting nugget in the data was that the retail and lodging numbers, which had come down pretty significantly. So let's see here, lodging was at 14%. And it came down to under 12% in Q1. It's actually on the way back up, at least for this quarter. I don't know if that's transitory or not, but that one's on the way back up, and retail as well. So not sure what to make of this yet. Maybe it's just a data kind of blip, or it's more than that. But The other thing that I'll just mention is that we do also get risk ratings on these loans from the bank contributors. And those are oftentimes I'd say a more up-to-date indicator of the loan performance, especially during COVID times when there was a lot of forbearance and those types of things. So I'd say the kind of percentage of loans in the higher risk rating buckets is a lot higher than 1.3% or whatever the delinquency rate is. So if you want a little bit more kind of color on all of that, feel free to shoot us an email, podcast@trepp.com. We have a ton of Northeast data in there. So for our New York bank clients, they really look at this pretty heavily to compare how they're performing versus a lot of other kind of New York, New Jersey, Boston, those types of loans. We have Chicago and Texas and California as well, but a really good big footprint in the Northeast.
So going through our property breakdown, let's start with office. And Manus, you have a special theme this week, and it has to do with grass.
Not that grass.
I was thinking that there was so much positive news this week in the CRE segment that in my mind, I thought there's more green shoots than a sod farm. And then it was really close to home. I grew up on Eastern Long Island, and our neighborhood was full of sod farms growing up. You couldn't go a quarter mile without driving into hundreds of acres stretch of just open space and perfectly manicured grass. So the delinquency rates themselves, that was a green shoot to start with. And we'll run through the property types kind of one by one. The biggest stuff came in offices, and I won't dwell on these too much. I'll just run through them quickly. This is a story from the Seattle Times. Microsoft and other tech firms hunting for even more Manhattan office space. You could put this down as a must know if you want. They name Roku and Microsoft as firms looking for new leases in Manhattan. Amazon, Facebook, and Stripe are also looking to add space to their existing footprints. And last week, as we mentioned, I believe last week, Google agreed to buy space in the meatpacking district for a development project that was already leasing. They purchased that for $2.1 billion. So great things happening in New York, driven by the tech market, and that's our first green shoot. Number two, I think this was a former must know. Visa agreed